following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp, brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, and that rockin' tune means it's time once again for Options Bootcamp. This is, of course, the show where we bring in raw options recruits, and then we break you down and break you of your misconceptions and your myths and your misperceptions of options, and then we rebuild you into seasoned options veterans. My name is Mark Longo from the OptionsInsider.com, as well as the Options Insider Radio Network. And I'm joined here on the old proving ground today by my fellow drill instructors, starting off with the man with the black hat and the whistle, none other than good old Dan Passarelli from Market Taker Mentoring.
Woo, 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 woo. Eddie Surgeon.
We need to get you a whistle.
that was the best whistle I could do, man.
We need to get some official. That might be a good little tchotchke for the show. Official Options Bootcamp drill instructor whistles, or perhaps drill instructor hats. I don't know. I think we might look good in some drill instructor caps too. What do you say, Dan?
Yeah, that'd be awesome.
Also joining us is our newest addition to our drill instructor team here. He is John Critchley, the options specialist and the educational majordomo over there at Sogo Trade. John, welcome back to the show.
Yeah, thanks for having me back. Do I get a whistle too?
Yeah, I think whistles all around. Okay. What do you say? And for our first Options Bootcamp live event someday, we'll have to have nice whistle tchotchkes for the audience and perhaps some nice hats. I don't know, John. I haven't met you in person, so I don't know how you'd look in a drill instructor cap. You think that would fit you?
I'm not sure. I used to have long hair. I have short now, so maybe it looks okay. We'll see. I'm going to see Dan hopefully in a few weeks. Maybe he can, if he sees you, he can bring one in for me.
There, perfect. There we go.
Yeah.
But yes, this is, of course, the show where we do dive into your options basics and start off from there. So with that, let's dive right into our basic training segment.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Call in. Print bear to learn. Yes, sir.
All right, cadets, it's time for some options basic training. And since we were on a bit of a hiatus for the summer, we're kind of going back to revisit some of the more interesting and more popular topics we hit on in some of those early shows, those very, very basic options concepts that we tried to drill into your head in episodes 1 and 2. And if you remember from those episodes, or a lot of you are tuning into us for the first time, so this is all new to you, all Greek to you even, because today we're going to hit on those variables that really are the center point, the crux of the options trading experience. And those are the Greeks: Delta, Gamma, Theta, and Vega. And John and I are lucky enough to be joined today by the man who literally wrote the book on the Greeks. Of course, good old Dan Passarelli from Market Taker Mentoring. And so he's going to give us an overview of really what are the Greeks, what each of those Greeks really mean, and then we can get into some of the more specifics. So Dan, why don't you take it from there, sir?
Yeah, all right. Thanks, guys. The Greeks are a metric to measure your sensitivity to things that make you or lose you money in options. It's kind of that simple. Of course, just knowing that simple fact, now we have to kind of roll up our sleeves and look under the hood and, kind of get some deeper explanations for these things. The Greeks kind of stem from the fact that options are more complicated than stocks and futures. There's more things that affect your profitability or your risk of loss than just simply the underlying moving. And we all know that options can be a leveraged substitute for a directional play, and that's what attracts many people into the options world, just that idea of leverage and protection. But there's more to it. Time affects the value of your options. Volatility affects the value of your options. Interest affects the value of your options. And all these things need to be taken into account when any trader is planning a trade. When you're forecasting, when you're looking at a stock chart, you have to put a time horizon in there. You have to consider the volatility level that's implied by where the market prices are, called implied volatility. And so we use the Greeks delta, gamma, theta, vega, and rho to help guide us in our decision making, given changes in all these variables that I just mentioned. They're kind of like the instrument panel on the dashboard of your car. You need to look at these things to know, how all these things that affect this task you're doing, driving, or in this case, trading options, how they are affecting you.
Well, you hit on those different Greeks there, Dan, and maybe we should just run through each of them individually. Of course, there's the major ones, which are delta, gamma, theta, and vega. You mentioned rho. Rho is one of those take it or leave it kind of Greeks. In some environments, rho is very important. In the late 70s, rho would have been a very, very pivotal Greek. These days, not so much. Rho is really a measure of sensitivity to interest rates. So I think we can probably table the rho discussion for another day when interest rates are a little bit more relevant to the conversation. But let's start with the Greek that many retail traders really view as the king, and that is delta. Give us an overview of delta and what that means for your introductory options trader.
Sure. Like I was saying, a lot of people, when they first get into options, they start out as directional traders trading stocks, and they hear, okay, I can take a leverage position by using options. So, hey, if I'm bullish, I can go out there and buy a call. That's great. But if I buy 100 shares of stock, or if I buy one call that represents 100 shares of stock, the stock goes up $3, I'm not going to make the same amount on both of those two choices. The call only profits a certain percentage of what the underlying stock would profit given the same move. So, for example, let's say a call has a delta of, let's say, 40. So that's 40%. You would see it in your option chain as 0.40. So what that tells you simply is that however much the underlying stock rises, that call will rise by 40% as much as that move. So if the stock goes up, let's say $1, the call will go up by 40 cents. Stock goes down $1, call goes down by 40 cents. So knowing this helps guide a trader's expectation, because, man, there's nothing worse than when you first start trading, you go and buy some calls and you say, oh, man, this is great. The stock went up $2. I should make a whole bunch of money. Hey, wait a minute. How come I only made 25 cents here? What the heck's going on? It's not enough to cover the bid-ask spread plus my commissions. Wait a minute. What's happening? Well, if you look at the delta, now you've got something to guide you. Now you're not just kind of winging it and, putting it all on black and hoping black comes up, you're being a little bit smarter about it. You have reasonable expectations, and you're able to manage positions better then.
That perhaps segues into an interesting discussion, which I think we should bring up, but maybe table the meat of it for another day when it's a little bit more advanced. But of course, that question that we've received all the time, and your example made me think of it again. It's probably the number one question we receive at the Options Insider. I'm sure with you, your mentees, Dan, as well, and John, I'm sure you with all your brokerage clients over there at Sogo Trade have a variation on this kind of delta theme, which gets into volatility as well, which is, of course, I bought the proverbial upside call before earnings, and let's say Apple or XIZ, whatever the case may be, the stock rallied $5 post earnings, and my call lost money. How did that happen? Which is an advanced take on delta and gets into some of the Vega as well. But that's a very, very common next step and a very common next question for a lot of traders who come in and cut their teeth on delta. And it's one I wanted to throw out there. I don't know if we have time to really address it in entirety right now, but it's one I want listeners to think of, and we'll all think of here on the panel, because we'll be back to it again, because that is, if there's a number one question we deal with, and John, I'm sure that's the case for you as well, it's probably that question. Am I correct?
That's probably our number one question that we get through our customers, and we can definitely address it either later in the podcast or in a future podcast. I just wanted to mention one thing about delta. The easiest way to understand delta when the customers call our desk is delta is a % chance that the option that you buy will be in the money by expiration. And of course, that makes sense if you look at your option chain and you see a at the money option and the delta is 50. Well, there's a 50% chance that the option will be in the money by expiration, and the out of money options will be a 10 delta, 10% chance. So that's an easy way for the new customer or a new retail client to understand delta.
Yeah, delta actually is that unique three-headed type of beast, because it actually has, three definitions. It has, of course, the options price sensitivity. Then, of course, it has what John just illuminated, which is, of course, the percentage probability of that option expiring in the money. And then for the pros out there, it also is the hedge ratio. It's what you need to use to hedge and remain delta neutral. So delta is that unique among the Greeks in that it has many, many definitions, all pointing you towards the same general type of topic and idea. But delta is definitely many things to many people. That's why I often refer to it as the chief Greek, particularly for many of those introductory retail options traders. Now, Dan, we're going to get a little bit deeper now into the deeper end of the pool and talk about, when you talk about delta, you have to talk next about gamma. And gamma is an interesting beast, because it's a very important Greek, but it's also one, particularly for new options traders, I tend to counsel them away from really spending too much time learning about gamma, because it can almost overwhelm them. It's a little bit of a thought process to get into what gamma is. So why don't we start there? What is gamma? Then we can get into maybe some of the specifics of what it does and how it's used.
Well, you're right. Let's start out with a simple textbook definition for context, and then we'll talk about what's important to know. Gamma is simply the rate of change of your delta as the underlying stock changes. So, for those of you who have studied delta, you know that in the money options have a delta greater than 50%, and the further in the money, the closer it is to 100. And out of the money options have a delta less than 50%, and the further out of the money, the closer to zero. That's all fine and good, but you have to appreciate that when the underlying stock moves, your option gets more in or more out of the money. So your delta logically must change. That is what gamma measures. Now, for some traders, that's really important. For you Bootcamp listeners, here's what's important to know. When you own an option, gamma helps you. Or when you have an option position that's sort of net long option premium, like maybe a debit spread where the long option's closest to the money, or a straddle, or maybe a back spread or something like that. Gamma always helps you. When you have a short option position or a spread where the characteristics are that of a short option position, like say, credit spreads, iron condors, and long time spreads and that sort of thing, you have negative gamma, and that always hurts you. And, the easiest way to understand this really is just to consider the long call perspective. If I own a call, if the stock goes up, logically I make money. That's what delta is. But as the stock goes up, that static strike price gets more in the money, right? So my delta has to get bigger. And when the stock is rising and my delta is getting bigger, that helps me extra. It helps me more than I would expect. And when the underlying stock falls, I'm losing money on my call, of course, via delta, but the call gets more out of the money, so my delta gets smaller. So I'm losing money, but I'm losing money at a decreasing rate, which arguably helps me as well.
Yeah, so gamma, like we said, it's interesting. It's an important concept to learn, but we usually try to give people just an overview, and then maybe when they get a little bit more familiar with options concepts, then we hit them with a little bit more gamma, because as we've seen, options can be very intimidating to the newcomer, and if you hit them with all this information at once, it could be certainly a little bit overwhelming. So we try to stick to the key ones like delta and some of the other Greeks we're coming up to. Speaking of which, one of the key ones that really becomes a focal point for a lot of options traders once they take that step and progress from the basic options trader to the little bit more advanced is they start to become very cognizant of this next Greek, Theta, which is your time decay. And this is an interesting one because this Greek can easily become your best friend for a lot of options traders, or also your very worst nightmare. And so, Dan, with that intro, why don't you take us away with Theta?
Sure. Theta is simply the rate of change of an option given a change in the time to expiration. As time passes, your option gets worth less. Theta measures that. Just to kind of state the case for time decay, as it's called, when your option gets worth less as time passes. If somebody gave you for free a call option, the right to buy a stock at, say, $50 a share, how long would you like to have that right? Would you like to have that right for 1 day or for 5 years? Logically, you would want to have this right for as long as possible. It gives you more time for the event to work out. So therefore, it's logical to deduce that options that have more time until expiration should have greater monetary value. Thus, as time passes, they lose their value. So this is a really important concept. If you own options, you've got something working against you. You've got time passing working against you, and you need to have expectations about that. You need to factor that into your planning. And that's why you need to look at Theta. It tells you, hey, today my option will lose X, all else held constant. Tomorrow it'll lose this. And it's pretty scientific, guys, for people who've never followed this before. I mean, it's down to the fraction of a penny that the Greeks enable you to understand how time passing affects the value of your option. And of course, those of you who are option sellers, you already get this. You love when time passes, but I know there's a lot of option sellers who don't think about Theta. They just say, well, hey, the more time passes, the better. But it's a lot better if you kind of have this more under your thumb and you say, yes, if I hold this position today, I make X. If I hold this position for a week, I make X times 7. So Theta is really, really important for option buyers or option sellers.
It's always fun for me to watch that transition occur when the new coming options traders, when those proverbial raw options recruits come in, listen to a show like this, and then they go to a brokerage and they talk to guys like John on the educational desk and they start to get a little bit of familiarity. They come in, they invariably, their first trade is typically buying a call, maybe buying a put, but usually buying a call is the way most people start out. So they start on the long side of the fence, and they quickly realize that Theta is their enemy, and they start realizing that decay, and they start cursing it, and they say, wow, this is really interesting and or difficult way to trade because I have this time factor that I never really had to deal with before when I was a stock trader. You could buy XYZ stock and hold it till oblivion. No one's going to really count that against you. But options have that ticking time factor, and so that becomes an issue. And then you see them slowly start to make that transition, for a lot of them anyway, as they start to become a little bit more sophisticated. They realize, wait a minute, we can make that time decay work in our favor, and that's when they start seeing Theta as a friend, is starting to enter into more spreads and short premium type of trades and that sort of thing, where they make Theta become their friend. And of course, you can easily overdo it and think all of options is just Theta and try to collect, which is what a lot of pros did back in the quote-unquote pros back in the 80s and early 90s, and it came back to bite them when the market started moving quite a bit. But it still is an interesting progression to watch. Is that something you see quite a bit over there at Sogo, John? People kind of coming in, testing the waters, buying a call, and then they start realizing how Theta really works, and they start turning towards more, let's say, premium neutral or even short premium types of trades because they want to make Theta work for them?
Yeah, right. And also they start reading more, and they come upon this stat that 80% or 75% of the options, they expire worthless. But that stat's very misleading. I tell the customers, this may be a true stat, but the 20% that turn out to be in the money, they can carry quite a wallop. And they always say the long premium traders on the floor, when I was trading, you may die a slow death. Slowly the theta decays. But the short premium traders, one day they're just gone. It's like they die instantaneously. So, options, just be careful. There's a selling point that might be good for you, and also a buying point. But there's no magic potion or magic answer to should I buy, should I sell. Don't let the numbers fool you.
Yes, there's definitely some people can go overboard with that and start thinking, well, I should never buy an option. There's certainly, I know when I first walked on the floor of the CBOE many years ago, there was the old saying, when in doubt, palms out, and options are insurance. And you make money selling insurance, not buying insurance. So certainly a lot of the old school guys definitely had that mentality. But John, you're right. I used to enjoy Expiration Friday. It's a difficult and also a potentially profitable time for an options trader. But you'd walk on the floor, you could instantly tell walking by any pit who the short theta guys were, because who the short premium guys were, because they were the ones sweating profusely, watching the clock, chomping on Tums the entire day. And you can see the guys who were more long premium, long gamma, and they were taking it a little bit easier. They still had to scalp and do a few things, but Expiration Friday was a much less, let's say, nail-biting experience than it was for the other guys. So it was always a fun little game for me to kind of walk around the floor and say, oh, that guy's short premium, that guy's really short premium, and trying to watch them make that work.
The one thing I did want to add is that from about early 90s to maybe 2001, if you were a premium buyer, either a trader or retail, that was a big winning strategy. But from 2001, 2002 to 2008, selling premium was a winning strategy. I think XPX which is the index volatility, was like 11% in 2004, 10% in 2005, 10% in 2006. So as you see, sometimes it pays to be long, sometimes it pays to be short. Just be nimble and be careful that you don't overdo it on one side or the other.
Yeah, I think that's the strategy the mindset we tend to espouse here on this show and on pretty much all of our programs on the Options Insider Radio Network, which is really, there is no one style that is perfect for every scenario. There's no one style that's perfect for every trader. Really, it's okay to buy an option on occasion, and it's okay to sell an option on occasion. We joke, actually, we do a show, a volatility program on this network, and one of our co-hosts there has a saying. He likes to say, options, you either sell them or don't sell them, but he refuses to buy. He's very old school in that sense, and so I like to give him a hard time about that. But I tend not to really. That's a very extreme mindset, and he doesn't really even hold that to that degree anymore. But there is that mentality out there. But certainly, I think for the bulk of the scenarios, it pays, as John just outlined. It pays. There are times you want to buy premium, there are times you want to sell premium, and knowing the Greeks is your first step along that path. And now, while we're on that path, let's get to the final Greek, last but certainly not least, and certainly in the eyes of many pros, what is to many of them the king of the Greeks, which is Vega. Dan, take us down the interesting and perhaps steep slope, and sometimes dangerous slope, that is Vega.
Vega is the most underrated Greek. Let's start with that by non-professional traders.
Oh, okay. I was going to say, wait a minute, but by non-professionals. I see where you're going now, sir.
Yeah. I mean, professional traders, Vega is probably the most important Greek. But non-professionals, a lot of times it just sort of doesn't register on their radar. They just don't even think about it, and they make or lose money just sort of willy-nilly based on Vega because they don't look at it. And boy, as a trader myself, that's dangerous. I don't like to have something making or losing me money without me knowing why. That's like not even looking at your brokerage statement, just sort of, hopefully there's money there, and so you need to look at Vega. Here's what Vega is. Vega is the rate of change of an option price as a result of a change in implied volatility. Now, for those of you who are pretty new to options, you might not be familiar with implied volatility. Here's what that is. Mark was saying earlier that a lot of people look at options as insurance policies. That's a great way to look at them in many different ways. And the most important way is from a valuation standpoint. If you're an insurance company and you're looking to insure two drivers. You got the applications, you're an underwriter, and you've got applications from two different people. One is a 40-year-old soccer mom driving a blue minivan, and one is a 17-year-old kid with a red sports car who's had 17 tickets last week. Who do you think is going to pay a higher premium? Well, clearly the one that has more risk of you losing money, more risk of you paying out, is going to pay a higher premium. That's exactly how options work. When there's greater perceived risk in the market or greater perceived volatility in the market, option premiums are higher. And when the perception of future volatility is lower, option premiums are lower. Now, that's the gist of it. We can, get into a pretty good philosophical discussion about some of the finer points, but that's the gist of it, and that's the important takeaway for what we're talking about here, and that's Vega. Vega measures the changes in that implied volatility level. When the 17-year-old kid driving record gets better and, he gets a job one day and he buys a sedan, he's going to end up paying a lower premium. That's how options work, but a lot faster. It doesn't take years. When the perceptions of future volatility change, the option implied volatility, that risk premium, changes as well. So Vega measures that. Now, this might seem a little bit esoteric, but there's a lot of times when this can be humongously important right before earnings, and likewise right after earnings, around other events. Seasonally, there are the effects of volatility that can be seen in option pricing. So it's very, very, very important for all traders, amateurs, professionals, basic, intermediate, advanced, always to pay attention to that implied volatility level and then let Vega register on your radar and use it to your advantage.
Now, you hit on an interesting point there, Dan, and we have a listener question about this. Perhaps we can just address it now because it is so topical, and that is, of course, that dichotomy, if you will, between the retail and the professional options traders and how they tend to look at the world and look at the options market. And I've made this statement many times, and people ask me about it all the time, so I'll just repeat it here today. And people ask me, what is the difference between a retail and a professional options trader? And there's a lot of different ways you can go, but what I invariably come down to is that in many cases and in many scenarios, the retail trader tends to focus and key his trading strategies around delta because he's a very directionally based trader. He'll go in and say, I think XYZ stock is going up. I'm going to buy a call. I'm going to buy a vertical, whatever the case may be. Whereas, maybe the higher end of the retail spectrum or the professional, if you will, they tend to key more around Vega. I know when I was on the floor, and you probably as well, John and Dan, I always thought of myself as more of a volatility trader than even an options trader. Volatility was my key Greek. In fact, we were trained from the moment we walked on the floor to be delta neutral, to minimize our directional risk whenever possible in order to really, really focus on our Vega risk and also our decay and some other things like that. So that's kind of ingrained in me, and that's kind of the way I look at options. But from the newcomer who's coming to options from the first time, typically from the stock side, they're used to trading stock in a directional basis. Stock is essentially a directional instrument. So they take that mindset and carry that with them over into options, and they begin to really focus on delta. And I don't think that's a terrible thing when you're first starting out, because it helps you wrap your mind around this process and how these products work. But once you start to get a handle on how these products work and how options trade, then the next logical step is really to understand Vega and how that plays into it. Because you're right, Dan. You see people all the time coming in. This plays into that number one question I referred to earlier. People are invariably buying a call before earnings, and the thing goes down as soon as earnings are announced, regardless of where the underlying moves, even if it rallies substantially. And that gets into the Vega component. They dramatically overpaid from a Vega perspective, and now that comes back to bite them. So if you're an options trader and you're coming to this show for the first time and you're coming to options for the first time, it's okay to really focus and learn and fixate on delta. But as you expand your trading horizons, Vega becomes very important. You start to learn the value of some of these Vega-defined trades and these defined risk types of trades that we like to employ on a little bit more of the sophisticated end of the spectrum. John or Dan, do you guys both agree with that? Do you think I'm full of it with my retail versus professional comparison?
Yeah, what is the most important Greek for the retail, delta or Vega? And the answer really is they're almost both equally important, But as you mentioned, the biggest mistake, or one of the biggest mistakes the retail customers make, is they are more concerned about the delta of the option and they ignore the Vega. And why is the Vega important? The most common question that we hear, and that I'm sure Dan hears and Mark, you hear all the time, is I bought some calls, the stock went $3 higher, they had a 20 delta, and the calls are only up 10 cents. Why is that? And the answer is the implied volatility, or Vega, went down in that option. So if you're a retail customer, make sure you have some understanding of the Vega and not just the delta.
Dan, do you see that with a lot of your mentees and your clients as well? They come in, they really tend to focus around delta, and you kind of have to shift them to the Vega side of the fence, if you will?
Yeah, man, I probably have this conversation every day with students. People do. They focus on delta. Some of the ones who, are maybe somewhat more sophisticated, they sell options and they at least know to look at Theta, though they probably don't focus on it too much. But yeah, they still let Vega fly under the radar, and then they can't understand. They say, well, yeah, I mean, it's just like John was saying. Yeah, what the heck's going on here? It's 40 delta. The stock went up $2. I should make 80 cents. How come I only made 40 cents? What's going on? Oh, those market makers are crooks. I mean, you get that all the time, and it's like, no, market makers aren't crooks. You're just not paying attention.
The good old beating up on the market maker. We hear that all the time.
Can I mention one thing, Mark? I think it's
Sure.
very important for this discussion. We get asked the question all the time, where the Greeks come from. And the simple answer, the basic answer is that options are priced off a pricing model. The first one was the Black-Scholes model, but there are variations that all different platforms and professionals use different ones. But that's the main formula. And in that formula, there are 6 variables that determine the price of an option. Of course, the stock price, the strike price, the time to expiration, interest rates, now are irrelevant, but interest rates, dividends, and most importantly, and lastly, is the volatility, or the Vega, which is really the standard deviation, which is a complicated term. But Vega is by far the most important component of the option pricing model. And implied volatility really is, when you look back at it and step back, is the option market's market price, how the option marketplace is pricing an option. All the Vega measures is a change in the option price or premium relative to a 1% change in volatility. So I think if you're a newcomer, I would read Dan's book. I would do more, go to Sogo Trade, to our education site, and learn about Vega. And just don't go in and buy an option because it's a delta. Look at the Vega, and look at the historical Vega. If the Vega is trading at 70, but normally it's about 30, well, hold on a second. Maybe I shouldn't buy it. But you should always look at the Vega and not just the other Greeks.
That's a good point, too, about the equation, because as newcomers familiarize themselves with the Black-Scholes equation, I know it sounds terrifying. You think, oh, why? I didn't know there's going to be a lot of math involved in this. But yes, there is. And this equation is relatively simple once you wrap your heads around it. But what's interesting about it, and what's useful, I think, for introductory options traders, is that it shows the importance, indeed the primacy, of Vega to options and options trading, because when you look at that formula, your delta relatively certain, relatively fixed, your theta and your gamma, the other things, they fluctuate a bit, but the primary variable that the options traders and the market makers are the ones really have control over, and what they really use to adjust and make their equations and their models fit to various market conditions is Vega. And that's why we used to tend to refer to ourselves as Vega traders, and why we were thought of ourselves as volatility traders, because we were constantly looking at things from a Vega perspective and adjusting our vols to their various market conditions. And that's essentially the fudge factor, I think, for lack of a better word, in those equations is the Vega. And so you start to see how important Vega is, and how you, as you adjust it, how that impacts other things like delta, gamma, and theta, and your other Greeks, and how they all have that interrelationship. So that's a good point, I think, to really encourage newcomers. It's a little intimidating, I know, but start to familiarize yourself with at least the basic concepts of Black-Scholes. That will explain a lot of different different things to you, not just the Greeks, and it'll start to really give you a better understanding for a lot of these very basic options concepts that form the bedrock for a successful options trading career. All right, I think with that, we've hit on all the Greeks concepts, so you can certainly listen to this episode. If you want some more on the Greeks, then you can tune into our earlier episodes of Options Bootcamp, where we have an extensive overview of the Greeks there as well as some trading recommendations. But now we're going to dive right into our mail call segment.
Mail call. Time to look at questions submitted by our listeners.
All right, and that very patriotic theme means it's time for the mail call, where you, the listener, get your chance to sound off here on the old Options Bootcamp program. And if you want to join our listeners who've written into us today, there's a number of ways you can get in contact with us. Of course, we've just recently redesigned the Options Insider to add a new comment system. So if you want to post a comment on an episode or on an article, or even post a question for us here on the show, you can do that in the comment system, and we'll read them here on the show and answer them for you. We can also reach out to us via Twitter, twitter.com/options, or on Facebook, facebook.com/optionsinsider, or just shoot us an email, questions@theoptionsinsider.com, and put in the subject line perhaps question for Options Bootcamp, so we know which show you're aiming for. And now let's kick things off here with a question. Well, the first one we've already kind of answered. This is a tweet from Texo5. He writes, Mark, why do you always say that retail options traders trade Delta and professionals trade Vega? Well, we just discussed that in the previous segment, so there you go, Tex, you have your answer. But that is a common refrain I like to use, and I think it's a relatively accurate one for the most part. And moving on here to an email from Evan in good old Atlanta, Georgia. He writes, can you guys explain the importance of dividends to an options trader? That seems particularly important given the recent snafu over SPY dividends. Why are dividends important to options traders, and how should it affect my options trading? That's an interesting question. And as you say, Evan, a very timely one, because listeners, if you're not familiar, there was a dividend on SPY, the very widely held S&P 500 ETF that occurred on Friday, the same day as options expiration. So that made for a double whammy, if you will, from an options perspective. And unfortunately, a lot of people were just unaware that SPY is a very liquid, very widely held product, and yet a lot of people trade it completely ignorant of the fact that it has a dividend component. So that, like we see every dividend cycle with SPY, a lot of people were surprised by that, and they were also caught unawares by the combination of options expiration, which made it particularly dangerous. And how do dividends affect options is probably the question. You probably heard us maybe on other option shows, or even on earlier episodes of this show, Dan and I, talking about how you really never should exercise a call option early. It just really doesn't make economic sense. We've talked about extrinsic value in calls before. When you exercise a call early, you lose all of that extrinsic value. It's just gone. And so if you're going to exercise a call early, you need to have something to come in to offset all of that extrinsic value, that premium that you're losing. And one of the few scenarios where it makes sense to do that is when you want to capture a dividend. Remember that options traders, options owners, don't get paid dividends. You don't get dividends. The only way to get the dividend is to become an owner of the underlying stock by that ex-dividend date. So as we saw on SPY on Friday, a lot of people who were long call positions in SPY had an incentive. There was a 78-cent dividend, a relatively substantial dividend. They had a very strong incentive to come in and exercise their calls early to collect that extra dividend. And so there's a little bit of shorthand we as options traders use to when you're looking at options, because we're focusing on call options because that's particularly where the dividend impact is most clear. So that's what we're going to focus on today. But even when we're talking about that, and we're talking about times when you want to early exercise a call to capture a dividend, even then, not every call option should be exercised. And there's a quick shorthand way to look and see if a call really is viable for exercising. That is to look and see if the extrinsic value of that call, or conversely looking at the price of the put on that same strike, which also will tell you the same thing. If the dividend is greater than the price of that put on that same strike, then it usually makes sense for you to exercise that call. So what that means is that typically those early exercises are going to be focused on that very narrow strip of in the money, usually deep in the money calls that have very, very low extrinsic values, and their puts are trading for essentially nothing. So in that case, like we saw in SPY, maybe SPY closed, I believe, at 145.87 on Friday. So the 143 calls, for example, and all these deep in the money calls had made a lot of sense to exercise those to capture that dividend. Now, what makes the dividend a little bit more dangerous, particularly when it occurs on a day like options expiration, is when you get towards the at the money strike and some of the near at the money, the near out of the money calls, where depending on the size of the dividend, the long call holder may have a incentive to exercise those as well. So if you find yourself short calls in one of these names that has a dividend, like SPY or any other underlying Apple, like a lot of these big names have dividends these days, you really need to be cognizant of that dividend impact, because you face, particularly if you're a short call trader, you face an increased assignment risk around the ex-dividend date. Now, what does that mean? That means, let's say you were short 10 of the September 146 calls in SPY on Friday afternoon. Now, the stock closed around 145.87, so just south of 146. So on a typical expiration day, you could assume that you're short those calls, and they're going to go out worthless, and so you're going to come in flat Monday morning with no position on in SPY. So you can go home and sleep well and know you're flat and you made your money and you're happy. But in this case, when the dividend was 78 cents, those 146 calls, even though they're a little bit out of the money, the options owners on those strikes had an incentive, a very strong incentive, to exercise those to try to capture that dividend. So if you were short that strike, instead of waking up flat on Monday morning, you could have woken up, let's say you were short that proverbial 10 lot, you could have woken up on Monday morning short 1,000 shares of SPY from 146. And if the stock gapped up on Monday morning, you could certainly see how that could be a very unintended and dangerous risk to your portfolio. So that's just one of the ways that dividends really can impact your options and your options trading. And certainly you need to be cognizant of whether or not the product you're trading, it becomes a little bit more difficult in some of these obscure ETFs and structured products that are starting to become very popular these days. You really need to look and see if there is a dividend component, because as we saw on Friday with SPY, you don't want to be taken by surprise by a dividend, because that could certainly, best case scenario, you leave a lot of money on the table because you don't exercise your call early, and so you don't capture that dividend. And in the worst case scenario, you have that short position that you didn't even know about, and you wake up on Monday morning short a substantial amount of a very, very volatile ETF. So either way, not exactly ideal, but that's kind of an overview of options and dividends and kind of what you want to pay attention to when you're talking about dividends with options. Dan or John, anything you guys want to add to that?
I will post an article that I wrote internally and on the blog about early exercise and capturing dividends, and I'll post it to theoptioninsider.com. But only thing I really wanted to say was, as far as dividends go, the call values do not like dividends, and put values do. And I'll post the article, and my answer right now might be too long-winded, but the article, I think, explains it pretty clearly. And one more thing I wanted to touch on also is that if you have an option that's in the money, and as you said, Mark, let's say there's $1. It's a $1 dividend. You need to look at the price of the puts where the puts are trading. If the puts are trading under $1, the calls are probably going to be an exercise. If the puts are trading above $1, they're probably not going to be an exercise. Again, that will be in my article, and I will post it in the next few days, and that may further clarify the issue for our listeners.
So look for that on theoptionsinsider.com by John Critchley. And Dan, anything to add on the dividend debacle?
No, you brought up some excellent points, guys. Dividends are really important. There's actually not a Greek that measures dividend risk, or at least not any that anybody's heard of. But they are really important. You can get really surprised sometimes, and it can have a profound effect on your profitability or lack thereof. I've actually got a whole chapter in my book, Trading Option Greeks, that discusses dividends and this kind of stuff.
There you go. So in addition to looking for John's article on theoptionsinsider.com, you can also look for Dan's book, Trading Options Greeks, available in finer bookstores and on Amazon. Just look for that one. Dan Passarelli, Passarelli. There you go, Dan. Here's your free plug for the day.
Thank you.
And last up here in the old mailbag, we have a Facebook question from Mike DeBrussi. And he writes, I'm hearing a lot about this being a, quote, low volatility environment. Apparently that makes it difficult for options traders. Why is that? Why does options volume drop so dramatically when volatility goes down? Should I wait to trade options until volatility/Vega goes up? Thanks for your help. And there are a lot of things to pick up on in this question, I think. But since I went on a little long about the dividends, I'll let you guys start with this one. So maybe, John, are you ready for this one?
Sure,
Okay,
I'm ready for this one. I wrote an article that I recently published in the Options Insider, and the title was Danger, Danger, the VIX is crashing. And in that article, I used a borrowed phrase or analogy. I don't know if I borrowed it from Mark or it's just out there. It's a simple analogy for option pricing. It's a house burning down analogy. The best time to buy home insurance is before your house catches fire. When your house catches fire, insuring your house is going to be cost prohibitive. And in the same way, options right now are very muted, but they're not going to remain that way, I don't think, forever. And when the worm turns, and with the slightest dark cloud, the cost of market insurance will dramatically escalate. How does this relate to option traders? Option traders, market makers, love volatility. The volumes go up. It's how they make money. And whereas the market may hate uncertainty, traders love uncertainty. In the grand old days and back in the 90s and the 2000s, there was unprecedented volatility, and a lot of market makers made a lot of money. When there's uncertainty, options sometimes do get mispriced. When there's certainty and the markets are nice and tight, it's harder for the market makers to make money. So I think it's a case where when the low volatility environment, no one's worried about buying insurance, so there's not that much activity. But when things happen like in 2008, the banking crisis, people get worried. They go out and buy puts. The volatility goes up, more volume. Calls go higher. There's more fear. So that's the answer right now. And if I would counsel this customer or this Mike, I would say be careful waiting till your house catches fire. You may be more well served by taking a protective position if you're nervous right now, because things will change and you don't want to be caught off guard.
An excellent characterization there, John. I would just add a couple things to that. First off, Mike here, he asked why does that low vol environment make it difficult for options traders? A couple of things. First off, volatility typically translates into movement in the underlying. So options traders, options market makers, they like a lot of movement in the underlying. It helps them to trade in and out of positions more. It's just generally more conducive to a more profitable trading environment. So a high volatility translates into more movement, which typically allows them to trade in and out of positions a little bit easier. Also, we talked earlier about how a lot of professionals and even very high-end retail traders tend to prefer selling options to buying options. And what we have in a low vol environment, the incentive to sell options is dramatically reduced. Your risk to reward ratio really skews in the wrong direction. So that also combines. So the two things, the lack of movement, the lack of incentive to sell options, those two things typically combine to really dramatically reduce volume in these types of low volatility environments. And one last thing I would counsel you on, Mike, I know it's a little thing, but you kind of conflated volatility and Vega in your question. It's a very easy thing to do, but it's important to remember that volatility and Vega are not really the same thing. Vega is your options sensitivity to volatility. So they are indeed highly related, but saying, oh, Vega is low right now, that doesn't really mean the same thing as, volatility is low right now. So there's something to caution you on, particularly since we're doing our Greeks episode today. It's worthwhile bringing up. Dan, anything you want to add here for our friend Mr. Mike?
Yeah, Mike, it is really important to take everything into perspective. A lot of people are talking about how low the VIX is these days, but you know what? Go back and look at a 5, 10, 20-year chart of the VIX. It goes back somewhat accurately, I think, into 1993, although it was a little different back then, but I think they recalculated it. You look at a very, very long-term chart of the VIX, and you'll see that it was down in this level for really extended periods of time, just kind of, bottoming out below 10 in many cases. So, kind of to shadow a little bit of what John said before, it's tougher to trade in these environments because you're kind of damned if you do, damned if you don't. If you're buying volatility, well, then that doesn't work so well because you're just buying insurance that you don't need and wasting money. Of course, if you're selling it, there's enough going on in the world where the VIX could easily be 30 tomorrow. So it is a whole lot more challenging. But hey man, if trading was easy, everybody'd do it.
Can I add one more thing?
Go ahead, Jeff.
And I just want to pick up on Dan's comment here. And I want to tell all our customers and our listeners, be careful just looking at the VIX. Because the VIX, if the VIX is low, 14, 13, 12, you may, and Dan kind of mentioned this, you may say, hey, this must be a buy here. But we've had long periods of time from 03 to 07 where the market didn't move that much. And if you were a big premium buyer and you bought a lot of premium, you lost money. So just be careful saying, well, the VIX is low, it must be a buy. There was actually a study done that showed in 2008, when the VIX traded around 80, which is a record high or near record high, that it actually paid to buy premium there. Because the realized volatility of the market, how much the market was really moving, was well over 100. The market was moving 5% a day or 7% a day back in those for a week or two. So for a short period of time, buying 80 volatility or 80 VIX, now you can't buy the VIX, but what was a winning trade. And that's a little counterintuitive. So be careful looking at the VIX and saying, oh, the VIX is 12. I need to buy some here. Just be careful. Sometimes you just maybe stay in the background and wait till the right opportunity comes.
I think we can probably do an entire show, John, about the misperceptions floating around the VIX and the different ways that it's marketed versus the way it actually performs and what the product actually is. That might actually be an interesting show, a whole volatility show down the road. So we'll have to keep that in mind. But for now, dear listeners, unfortunately, that's going to do it for this episode of Options Bootcamp. We, of course, want to thank all of you out there for downloading and streaming and subscribing to the show and making it such a success. And, of course, all of you who wrote in and joined us on the show today. We want to encourage all of you to keep that up. Send your questions in, questions at theoptionsinsider.com or at any of the other ways we outlined, including the comment section on theoptionsinsider.com. And, of course, you can keep up with all of my fellow options drill instructors and learn more about what they have to offer, including what's going on over in the land of Sogo Trade. Just visiting www.sogotrade.com. You can check out that interesting Greeks visual tool that John was mentioning before, as well as a number of other interesting tools they have there to kind of walk you through a lot of these concepts and help you understand options trading a little bit better. And John, they could obviously find more at sogotrade.com. What are some other ways that they could keep in touch with the folks over at Sogo? Do you have a Twitter account, Facebook? What else is going on over in Sogo land?
Yeah, we just started a Twitter account. It's Sogo Trade Option, and that's a Twitter account that I use right now. And we have a Facebook we just launched. Of course, I try to write articles as much as I can, maybe once or twice a week for theoptioninsider.com. But if you go to our website, you'll find us there, and we hope you give it a whirl.
So indeed, check out, again, sogotrade.com and play with some of those interesting tools they have. And if you're interested, sign up for an account. They're offering you 100 free trades right now, so it doesn't get much easier than that, at least from a commissions perspective, to kick the tires and light the fires, as they say, and see if that platform really works for you and if options are the right tool for you. Before we go, Dan, I want to thank you for joining us as well today. Anything interesting coming up at Market Taker Mentoring?
Oh, man, there's always something interesting coming up at Market Taker Mentoring. One of the things is the second edition of my book, Trading Option Greeks.
Oh, there we go.
It's out finally.
It's been so long I'd forgotten that it was on the horizon there.
Yes, and it's going great. I made some new additions into that book, hence the name second edition, and it is really, really fantastic. And please feel free to check it out. Go to Amazon. I think that's the best deal you're going to find out there, but it's in the brick and mortar stores too.
So forget my plug for the first edition of the book earlier, and instead, listeners, cancel that order if you've already made it during the show, and instead go ahead and order the second edition, because they'll have a lot of more interesting and more updated stuff for you to check out. And again, we want to thank all of you out there for downloading and streaming and subscribing to the program and making it such a success. And we'll see you next time right here on Options Bootcamp.
Options Bootcamp is brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.